If you are 65 or older and receiving old age security in Canada, there is a very good chance the government is quietly taking some of that money back, and most seniors have absolutely no idea it is happening to them. In 2026, the OAS Clawback threshold has been updated, and if your income crosses a certain line, you could lose hundreds or even thousands of dollars from your OAS payments every single year. But here is the thing. There are 5 completely legal strategies, all accountant approved, that can help you reduce or even eliminate that clawback entirely. And by the end of this video, you are going to know exactly what they are. So stay with me, because this information could put real money back in your pocket. Welcome back to MR.JACK, your trusted source for the latest updates on Canadian government benefits, retirement income, and financial strategies designed specifically for Canadian seniors. If you are new here, please take a moment to hit that subscribe button, because every week we bring you clear, honest, and up-to-date information about CPP, OAS, GIS, and all the changes that directly affect your retirement income. Today, we are diving deep into one of the most important financial topics for Canadian seniors in 2026, the OAS recovery tax, more commonly known as the OAS Clawback. We are going to explain exactly what it is, who it affects, how much it could cost you, and most importantly, 5 legal and accountant-approved strategies you can use right now to protect your benefits and keep more money in your hands where it belongs. Before we talk about how to avoid the clawback, let us make sure we are all on the same page about what old age security actually is and how it works in 2026. Old Age Security, or OAS, is a monthly pension payment provided by the Government of Canada to Canadians who are 65 years of age or older. Unlike the Canada Pension Plan, which we will talk about in a moment, OAS does not depend on how much you worked or how much you contributed during your working years. As long as you meet the age and residency requirements, you are generally entitled to receive it. In 2026, the basic OAS payment for seniors aged 65 to 74 is approximately $727 per month. For seniors aged 75 and over, the government provides a boosted amount, about $800 per month, thanks to the 10% increase that was introduced for that age group in recent years. These amounts are adjusted quarterly based on the Consumer Price Index, which means they go up slightly when the cost of living rises. Now, OAS sounds straightforward. You turn 65, you apply, and you receive your payment each month. But there is a catch, and this catch affects far more Canadian seniors than most people realize. That catch is called the OAS recovery tax. And this is what most people refer to when they say the OAS clawback. Here's how it works. If your net income for the year goes above a certain threshold, the government begins to claw back your OAS payments. For the 2026 tax year, that threshold sits at approximately $90,997. For every dollar of net income you earn above that amount, you must repay 15 cents of your OAS benefit back to the government. So for example, if your net income is $100,000 in 2026, that is roughly $9,003 above the threshold. 15% of that is about $1,350, meaning you would lose $1,350 of your OAS payments for that year. And if your income is high enough, you could lose your entire OAS benefit. The point at which OAS is fully clawed back in 2026 is around $148,179 of net income. At that level, your OAS payment goes to zero. This affects more Canadian seniors than you might expect, especially those with income from multiple sources such as RRSP withdrawals, rental income, part-time employment, investment income, or CPP combined with workplace pensions. The key thing to understand is this: the clawback is based on your net income as reported on your tax return, and that means there are legitimate legal strategies that can reduce that net income number, and therefore reduce or eliminate the clawback. Let us talk about those strategies now. This is one of the most powerful and most underused strategies available to Canadian senior couples, and it is completely legal. Pension income splitting allows you and your spouse or common law partner to split eligible pension income on your tax returns. The income that qualifies includes payments from a registered pension plan, annuity income from an RRSP or DPSP, and income from a RRIF, which is a registered retirement income fund. Here is why this matters so much for OAS clawback purposes. The OAS clawback is calculated individually. It is based on your individual net income, not your household income. So if one spouse has a high income and the other has a lower income, shifting some of that income to the lower income spouse can bring the higher income spouse's net income below the OAS clawback threshold. Let us use a simple example. Say one spouse has a net income of $110,000 and the other has a net income of $50,000. Without splitting, the higher income spouse is about $19,000 above the 2026 clawback threshold, and they would lose around $2,150 in OAS payments. But if they split $15,000 of pension income to the lower income spouse, the higher income spouse's income drops to $95,000. That brings them much closer to the threshold and significantly reduces their clawback amount. To do this, both spouses complete Form T1032, the joint election to split pension income, when filing their tax returns. A tax professional or accountant can help you optimize the split to get the best possible outcome for both partners. This strategy alone has saved many Canadian couples thousands of dollars every year. If you are married or in a common law relationship and your incomes are unequal, this should be the very first strategy you discuss with your accountant. This strategy is about being smart with the timing of your registered account withdrawals, and it requires a bit of planning, but the payoff can be significant. Here is the situation many Canadian seniors face. They have money sitting in an RRSP, a registered retirement savings plan, and under Canadian tax law, they must convert that RRSP to a RRIF by the end of the year they turn 71. After that, they must withdraw a minimum amount from the RRIF each year, and those withdrawals are counted as taxable income. For many seniors, large RRIF withdrawals push their net income above the OAS clawback threshold. This is a very common problem, especially for people who saved diligently during their working years. The solution involves planning your withdrawals carefully before you are forced to take them. One approach is to make voluntary RRSP or RRIF withdrawals earlier, in the years between retirement and age 71, when your income may be lower. By drawing down your registered accounts gradually during lower income years, you reduce the size of your mandatory RRIF withdrawals later and prevent large spikes in taxable income. Another approach is to convert your RRSP to a RRF before age 71 if your income in a given year is especially low. You can choose when to begin RRIF withdrawals, and by timing this strategically, you can control how much taxable income you recognize in each year. The key goal is to smooth out your income over multiple years rather than having large, sudden jumps that push you above the OAS clawback threshold. This strategy works best when planned several years in advance. If you are approaching retirement or are in your early retirement years, sit down with a financial planner or accountant and run the numbers. You may be surprised how much you can save over time simply by managing the sequence and size of your registered account withdrawals. The tax-free savings account, or TFSA, is one of the most powerful tools available to Canadian seniors, and it is particularly valuable when it comes to avoiding the OAS clawback. Here is why. Any income earned inside a TFSA, including interest, dividends, and capital gains, is completely tax-free, and because it is tax-free, it does not count toward your net income on your tax return. Remember, the OAS clawback is based on your net income. So income that does not show up on your tax return cannot trigger the clawback. By moving your investments, particularly income-generating investments, into a TFSA, you can earn money without increasing your taxable income at all. In 2026, the cumulative TFSA contribution room for someone who has been eligible since the program started in 2009 is over $95,000. If you have not been maximizing your TFSA contributions over the years, you may still have significant room available to you. And even if you have used your TFSA before, withdrawals made in a previous year create new contribution room in the following year. Let us think about this in practical terms. If you have $100,000 in a non-registered investment account earning 5% annually, that is $5,000 of taxable investment income per year. Depending on your other income sources, that $5,000 could push you above the OAS threshold and trigger a clawback. But if that same $100,000 is inside your TFSA, those earnings are invisible to the tax system. They do not add to your net income. They do not affect your OAS payments at all. If you are currently holding savings or investments in non-registered accounts, moving them into a TFSA, to the extent that you have available contribution room, can be one of the most effective steps you take to protect your OAS in 2026 and beyond. This strategy is one that many seniors overlook, and it is one of the simplest. The OAS Clawback is based on your net income, and net income is your gross income minus certain deductions. That means the more legitimate deductions you claim, the lower your net income, and the less likely you are to trigger the clawback. There are several deductions and credits that Canadian seniors frequently miss or underclaim. The first is the deduction for RRSP contributions. If you or your spouse still has RRSP contribution room and you are under the age of 71, contributing to your RRSP directly reduces your net income for the year. Even a modest RRSP contribution can make a meaningful difference if it pushes your income just below the clawback threshold. The second is the deduction for carrying charges and investment expenses. If you pay fees to manage your investments, those fees may be deductible, and they directly reduce your net income. The third is the deduction for business losses or rental losses, if applicable. If you operate a small business or own rental property and have eligible expenses, those deductions reduce your net income. The fourth is the pension income amount, a federal tax credit available to seniors who receive eligible pension income. While this is a non-refundable tax credit rather than a deduction, it reduces your tax liability and is something every eligible senior should be claiming. The fifth is medical expense credits. Many seniors have significant out-of-pocket medical costs, including prescriptions, dental work, mobility aids, and home care. These can be claimed as medical expenses and reduce your tax burden. The sixth, and this one is especially important, is the age amount credit. Canadians who are 65 or older are entitled to claim a federal age amount credit. In 2026, this credit helps reduce tax on lower-income seniors and is worth claiming every year you are eligible. Working with a certified accountant or tax professional to ensure you are claiming every deduction and credit available to you is one of the smartest investments you can make. For many seniors, a single meeting with a tax professional pays for itself many times over. This final strategy is a bit different from the others, and it requires careful thought, but for the right person, it can be extremely valuable. Did you know that you can choose to delay your OAS payments? You do not have to start receiving OAS the moment you turn 65. You can defer your OAS start date by up to 5 years, all the way to age 70. And for every month you defer, your OAS payment increases by 0.6%. If you defer for the full 5 years, your monthly OAS payment is 36% higher than it would have been at age 65. Now, why would this help with the clawback? There are 2 reasons. The first is financial. If you are still working between ages 65 and 70 and your income is above the clawback threshold during those years, there is no point in collecting OAS only to have it clawed back entirely. By deferring, you avoid the clawback during those high-income years, and you collect a larger clawback-free benefit once your income drops in later retirement. The second reason relates to tax planning. By deferring OAS and timing it to start in a lower income year, you may be able to collect your full benefit without triggering any clawback at all. Of course, this strategy does not make sense for everyone. If you are in poor health, if you need the income now, or if your income is already below the clawback threshold, deferring OAS may not be the right choice. The decision depends on your personal health, your financial situation, and your other income sources. But for seniors who are still working past 65, who have substantial retirement savings, or who are in good health and expect a long retirement, deferring OAS can be a smart and legal way to maximize your lifetime benefits and minimize your clawback exposure. Talk to your financial advisor or accountant about whether OAS deferral makes sense in your specific situation. It is a conversation worth having. Now let us take a few minutes to talk about the Canada Pension Plan, CPP, and what has changed in 2026. The Canada Pension Plan is Canada's contributory, earnings-based social insurance program. Unlike OAS, CPP is funded by contributions made by workers and employers throughout their working lives. The amount you receive from CPP depends on how much you contributed and for how long. In 2026, the maximum monthly CPP retirement benefit for someone who starts collecting at age 65 is approximately $1,133 per month. The average monthly payment, however, is significantly lower, typically around $750 to $800 per month, because not everyone contributes at the maximum level throughout their career. One important update for 2026 relates to CPP enhancement. Canada has been in the middle of a multi-year CPP enhancement program that began in 2019. This enhancement means that workers who contributed under the enhanced rules during their working years will eventually receive higher CPP benefits. If you retired recently or are planning to retire soon, your CPP payment may be slightly higher than what older retirees receive, reflecting those enhanced contributions. It is also worth noting that CPP income, like OAS income, counts toward your net income for tax purposes. This means that higher CPP payments can push you closer to or above the OAS clawback threshold. For seniors receiving both a full CPP benefit and OAS, combined with income from other sources, this can create a situation where the clawback becomes a real concern. The strategies we discussed earlier, particularly pension income splitting, TFSA sheltering, and strategic RRIF management, are all relevant to managing the combined effect of CPP and other income sources on your OAS clawback. Another option worth mentioning is the ability to defer CPP, just like OAS. You can delay your CPP start date past age 65, up to age 70, and receive a higher monthly amount. For each month you delay past 65, your CPP payment increases by 0.7%, which translates to an 8.4% increase per year. If you delay to age 70, your CPP is 42% higher than it would have been at 65. Again, whether to defer CPP is a personal decision that depends on your health, your finances, and your other income sources, but it is a legitimate tool for managing your retirement income, and for some people, it can work alongside OAS deferral to create a more tax-efficient retirement plan. Let us now talk about the Guaranteed Income Supplement, or GIS, which is one of the most important programs for lower-income Canadian seniors. The GIS is a monthly, non-taxable benefit provided in addition to OAS for seniors who have a low income. To be eligible for GIS, you must be receiving OAS, and your annual income must fall below a certain threshold. The exact threshold depends on your marital status. In 2026, single seniors with annual income below approximately $21,624, not counting OAS itself, may qualify for GIS. For couples, the combined income threshold is higher, with different rules depending on whether both partners receive OAS or just one. The maximum monthly GIS amount in 2026 for a single senior is approximately $1,086. When combined with the full OAS payment, a single low-income senior could receive over $1,800 per month in combined OAS and GIS benefits. One very important thing to know about GIS is that it is not taxable income. Unlike OAS and CPP, GIS payments do not count toward your net income for tax purposes. This is significant because it means receiving GIS does not push you toward the OAS clawback threshold. However, here is something many seniors do not realize. GIS eligibility is based on the previous year's income. So if your income in 2025 was low enough to qualify for GIS, you may receive it in 2026, even if your income in 2026 is higher. Conversely, if your 2025 income was too high to qualify, you will not receive GIS in 2026, even if your 2026 income drops significantly. If your income drops significantly due to retirement, a change in circumstances, or reduced investment returns, you can apply to have your GIS calculated based on your estimated current year income rather than your previous year's income. This is done using what Service Canada calls the Statement of Estimated Income form. If you believe you may be eligible for GIS but have not applied, or if your income has recently decreased, contact Service Canada to find out if you qualify. It is also worth noting that GIS is not automatically paid. You must apply. Many eligible seniors miss out on GIS payments simply because they did not know about the program or did not realize they qualified. If you or someone you know is a lower income senior receiving OAS, please look into GIS eligibility. It is free money from the government, and it could make a significant difference in monthly income. Now, before we wrap up, there are several important alerts that every Canadian senior needs to hear. Please pay close attention to this section. When the government calculates that you owe an OAS recovery tax, it does not take a lump sum from you all at once. Instead, it reduces your monthly OAS payments throughout the following year. This means that if you triggered a clawback in 2025, your 2026 OAS payments will already be reduced at the source. before you even receive them. Many seniors are surprised when they see their OAS payments are lower than expected. This is often the reason. If you experienced a high-income year, check your notice of assessment from the CRA to see if a recovery tax has been applied, and then use the strategies in this video to reduce your income in future years. A common mistake made by Canadian seniors is making large RRSP withdrawals in a single year, often to fund a major purchase or out of a belief that they should use the money while they can. While this is understandable, a large one-time RRSP withdrawal can push your income far above the OAS clawback threshold and result in a significant loss of OAS benefits. If you need to access a large amount from your RRSP or RRIF, consider spreading the withdrawals over several years rather than taking it all at once. Even a small change in timing can prevent a spike in income that triggers the clawback. If your income changes significantly, for example, if you stop working or your investment income drops, you may become newly eligible for GIS or for a reduced OAS clawback. However, Service Canada and the CRA will not automatically adjust your payments based on your new situation. You may need to contact them directly or file an updated income statement. Do not assume the government knows your income has changed. Take the proactive step of notifying them and ask whether your current benefit amounts should be reviewed. There are many online calculators and tools that claim to estimate your OAS and GIS amounts. While these can be helpful for general planning, they are not always accurate, especially when your income situation is complex or when recent government changes have not yet been reflected in the calculator. Always verify your benefit amounts directly with Service Canada and consult a qualified accountant or financial planner before making major decisions about your retirement income. The strategies discussed in this video, particularly pension income splitting and RRSP contributions, are only effective if your tax return is filed correctly and on time. The deadline for most Canadians to file their annual income tax return is April 30th. If you or your spouse are self-employed, the filing deadline is June 15th, but any taxes owing are still due April 30th. Filing late can result in interest charges and penalties, and may affect your eligibility for income-tested benefits like GIS. Make sure your taxes are filed on time every year. All right, let us bring everything together. Today, we covered 5 completely legal and accountant-approved strategies to help you avoid or reduce the OAS clawback in 2026. Strategy 1 was pension income splitting, a powerful tool for couples where one partner has higher income. Strategy 2 was strategic RRSP and RRIF conversion timing, to smooth out your income and avoid large spikes that trigger the clawback. Strategy 3 was using your TFSA to shelter investment income from the tax system entirely. Strategy 4 was claiming all available tax deductions and credits to reduce your net income on paper. And Strategy 5 was deferring your OAS to a higher clawback-free amount, especially if your income is still high in your early retirement years. We also covered the 2026 updates to CPP, including the ongoing enhancement program and the option to defer CPP to age 70 for a higher monthly benefit. And we looked at the GIS and the Guaranteed Income Supplement, which is a valuable tax-free benefit for lower-income seniors that many Canadians are eligible for but have never applied to receive. The bottom line is this: the OAS clawback is not inevitable. With the right planning and the right strategies, you can protect your benefits, keep more of your retirement income, and make the most of everything you have worked so hard for. But planning takes information, and that is exactly what we are here to provide. If you found this video helpful, please give it a thumbs up. It helps other Canadian seniors find this information and get the support they need. And if you have not subscribed to MR.JACK yet, now is the perfect time. Every week we bring you clear, trustworthy, and up-to-date information about CPP, OAS, GIS, and all the government benefits and financial changes that matter most to Canadian seniors. Hit that subscribe button and ring the notification bell so you never miss an update. If you have questions about anything we covered today, drop them in the comments below. We read every comment and do our best to help. Until next time, stay informed, stay protected, and take good care of yourself. This is Mr. Jack, and we will see you in the next video.